It's the 25th of May, and you're listening to Kopi Time, a podcast series on markets and economies from DBS Group Research. I am Taimur Beg, Chief Economist. It's a long weekend here in Singapore for the Eid festival, whereas in the US, it's also a long weekend due to Memorial Day. But there's hardly a breather as far as markets are concerned, with major developments a near constant feature these days. Just as some countries around the world are tentatively easing their lockdowns after several months of highly restrictive measures, causing a dramatic correction in their activities, there is drama in the form of renewed China-US tension on fronts ranging from technology rivalry to Hong Kong, and a major German-French proposal for a 500 billion euro recovery fund raised by the European Commission borrowing on capital markets, and some promising developments with respect to developing antiviral drugs and vaccines. All of these things are taking place even as emerging market economies like Argentina, Brazil, Russia, India, Indonesia, and South Africa continue to suffer from economic distress and the lingering impact of the pandemic. So let's talk to an authority figure who helps us cut through all this noise. It gives me distinct pleasure to welcome Dr. Komal Sri-Kumar to our show. Sri joins us from Santa Monica, California, where he's the president of Sri-Kumar Global Strategies Incorporated, a macroeconomic consulting firm he formed in January 2013. The firm advises multinational firms and sovereign wealth funds on global risk and opportunities. Prior to founding the firm, Sri worked as the Los Angeles-based Trust Company of the West, TCW, from 1990 to 2012, serving for the last few years as the firm's chief global strategist. And I personally had the distinct pleasure of visiting Sri at his office a few times during those days. Before his work at TCW, Sri was the senior vice president at the Beverly Hills-based Drexel, Burnham, Lambert, and executive vice president at DBL Americas, specializing in country risk analysis. Sri is also a senior fellow at the Milken Institute. Many of you have probably seen him many, many times on CNBC and Bloomberg in recent years. Sri, welcome to Kopi Time.
Good to be with you, Timur.
It's a pleasure is all ours. Sri, to those who don't follow you on Twitter or don't watch you on TV, maybe there's not a lot of them, but some are, they probably would be surprised to know that you have been vocal with a bearish outlook on the global economy for quite a bit of time. In fact, way back in January, you were quoted expecting a US recession this year. Sri, let's start with that. What made you form that bearish view at a time when US employment rate was, at historic record strong numbers, asset markets were soaring, and China-US trade tensions were ebbing? Why were you looking at a recession at that point?
Timur, it's very important not only to look at coincident indicators, such as the low unemployment rate that we had at the end of 2019 and beginning of 2020, but also to look ahead and you see if you are at the peak, which means that you're about to fall off the peak into a crevice. That should not give any satisfaction that things are going well. Now, what was wrong in late 2019 or early 2020 before coronavirus struck? One, even though the unemployment rate in the United States was at a 50-year low, what we know that the participation rate of the labor force simply did not come back to its pre-2008 highs. So in other words, unemployment rate was low, but as a percentage of the population, the labor force was getting to be smaller than it was at the peak before. Why is that significant? Let us take the extreme and make an extreme assumption. I can create, Timur, an unemployment rate in an economy of zero by essentially sending everybody away from the labor force. Put differently, if the labor force participation rate were zero, I can always get a zero unemployment rate. And if you looked at the unemployment rate, things look very good. But you have to look at the participation rate to know that fewer and fewer people are participating, and that's why your unemployment rate is low. That's the first point. Second, look again at the labor market. For supposedly a market with very little slack, we did not have any wage growth. According to the Bloomberg data calculations, average real weekly earnings in the United States year on year in December of 2019 increased 0.1%. Think about that. Your real wages changed 0.1% over 1 year when your labor market is supposed to be have no slack at all. So I look at those and thought that in turn was a very significant signal. Third, where else are you looking at? The equity markets were flourishing. They were doing very well. And as we know, they went on to hit a record high for the S&P 500 in February. But then go back and look at history. October of 2007, 2 months before the Great Recession began, the S&P 500 hit a record. So if you looked at the equity market, things were doing very well indeed, no problem. But the 10-year Treasury yield in the United States had already inverted, and ahead of December 2007, the yield curve had started steepening in anticipation of a Fed easing after a recession began. The same phenomena have continued in 2018 and 2019, and I took that to heart. So in other words, equity market has not been a good predictor of the economy in the last two recessions, the recession of 2001, the recession of 2007 to 2009, and the bond market behaved better. So to summarize, you get the signal from the labor market itself about a lack of slack. Second, you get the signal also from the financial markets.
This is so succinct and so to the point, Sri. I think that sort of explains your thesis very well. Now, of course, timing is very hard to predict. And as you said, that the signals, particularly from the fixed income market, was present for a couple of years. But you still felt that we were no more than 6 to 9 months away from correction in the economy coming at a time when sentiment around the China-US Phase 1 deal was pretty strong. So did you feel that those sort of drivers were actually not particularly substantive?
That's a great question, Timur. I thought the US-China trade deal, which was reached by President Xi and President Trump in terms of China purchasing more of US farm goods during 2020 and increasing it, and of course it was trumpeted as a big victory on the United States. I then went public saying China would not make all the big increase in purchases that had been published. So in other words, this was pre-coronavirus, mind you, that I didn't expect the purchases to be taking place. And the reason was that the US goal was too ambitious. We were looking for $200 billion more of purchases to be completed very quickly, going back to the 2017 level. And the Chinese would have to do it by only from US farmers, not from Brazil, not from Argentina, only from the United States, in order to meet its commitment. It was simply not going to happen. Think about it. If I were a US farmer, I can simply increase my price with the certainty that the Chinese are forced to buy my products. That's not going to happen. So those were all the reasons I was skeptical that the trade deal would amount to very much. But of course, the coronavirus put a kibosh on the whole thing. And essentially, because of that, the purchases are simply not going to happen in 2020. So those were some of the reasons for the skepticism on the US-China side. This was even before all the US allegations about where coronavirus started from, all the more recent, very recent problems on Hong Kong. But it goes back to simply whether the Chinese could comply with their purchases.
Yeah, absolutely, Sri. In fact, if I look at the last 4 months of trade data, so January, April 2020, of course, China is importing and exporting less to and from the US. But at the same time, there is a relative difference in the performance of the two economies already, because China sort of was early in the downturn with respect to COVID-19 and now is beginning to show some tentative signs of turning around. So China's imports from the US are down about 5%, but China's exports to the US are down about 9% because the US is nowhere close to bottoming out yet. So I see that, the chance of that sort of, trade imbalances, getting corrected in the U.S. favor that Mr. Trump is so fixated on is going to be, even if it corrects a bit, will be a low-quality correction because it would not be accompanied by massive amount of imports from the U.S. It will still be a contraction. Sri, then let's talk about the current juncture, your assessment of the global markets at this point. And maybe we start with the equity markets where the valuations, particularly in the U.S., have rebounded quite dramatically in the past 2 months.
They have risen sharply, and I think the reasons are twofold. One, even now, there is a consensus that holds on, if not to a V-shaped recovery from the coronavirus crisis, at least that it'll be a shallow U, if you will, and then rising very quickly. That is one reason for the optimism that all the amount of stimulus that the Fed and US Treasury have given will be helpful here. And along with it goes the expectation that if the stimulus were not enough, the Fed and Treasury would do more. So this is a fundamental problem we have with US economic policy. You can always pull the Fed's chain from the market. If the market corrects 10%, 15%, the Fed will announce a new measure to provide the support. This is not supposed to be the Fed's mandate, which is just economic growth and inflation management, but they do, without really admitting it, go into the equity market side as well. So those are all one of the reasons, I think, why the equity market has done so well. Second, on the coronavirus front, from time to time, we have optimistic news about a vaccine being found. And also, the US has started opening up, and especially this being Memorial Day weekend, many of the beaches are opening up and the weather is heating up. And so the expectation is that that means the economy will come up along with the opening up. I am doubtful. I think I fear a secondary wave of the virus, especially since we simply do not know the origins of it. We do not fully understand how it spreads, and we don't have a vaccine. So if you're going to put a lot of people at close quarters, and if you're sitting in a restaurant or if you're sitting in a beach, you're not going to wear a mask, it is clear that the disease is going to spread. So the way I see it is that you have some form of a shallow recovery in the third quarter, but if that happens, then you go down again in the fourth quarter much more sharply. So the equity market is, I think, over-optimistic. Once again, look at the Treasury market, my favorite friend from the last 20 years. The US 10-year Treasury is at 65 basis points. What happened to all the optimism? When the equity market surged, why isn't the 10-year at least at 1.5%? The Treasury market is showing you that it's very skeptical, even as the equity market shows its exuberance. And that's simply a continuation of the past trends of the two different variables, Timur.
Sri, so apt. In the previous podcast, I talked to Professor Wang Linfa, who was the person who actually discovered the bat-to-human jump of the SARS virus way back in 2003. He's right now at the cutting edge of all the research work that's going on antibodies and vaccines, and is on several working groups with the WHO. After a 45-minute chat with him, I came away with the impression that there's still so much uncertainty. And even a foremost authority like Professor Wang was very humble about the points that you just made, that we still don't know a lot about this virus. And therefore, to take very bold public policy decisions like, open up the beaches and so on, is a bit of a gamble. It may work out if we get lucky, but we have really no idea. And it may be, a humbler way of approaching it might be the right thing to do. And therefore, so I fully concur with your point. Yes, as you said, your favorite friend is the rates market. And you have been, I think, the big Cassandra as far as the fixed rates market has been the last couple of years, and of course gotten it right repeatedly in terms of the downward march of the U.S. interest rates. So we will talk about the Fed's sort of scorecard over the last 2 months a little later, but I want to ask you about the fateful choice that the Fed made in December 2018. that in November, early December, Fed officials were still very confident. They were committed to continuing to, sort of gradually increase the interest rate. Equity market went in a tailspin, and by the end of the month, they were already trying to assure everybody, and then they paused, and within 6 months' time, they were cutting rates in mid-2019. Was that a big mistake?
I would tell you, you touched upon a very favorite topic of mine, Timur, so I hope you won't mind if I expand on it. There was a sea change in the Powell statement of Wednesday, December 19th, 2018, at the end of a two-day Fed meeting. And what he did at the American Economic Association meeting in Atlanta, Georgia, on January 4th. Just 2 weeks had passed between December 19th of 2018 and January 4th of 2019, but Mr. Powell had done an absolute pivot in terms of what the policy was going to be. December 19th, he talked about 3 rate increases taking place in 2019. He seemed enormously confident, and I then tweeted out and also said publicly he had no reason to be so confident. The labor market was not strong, the wages were not increasing, and any improvement that they had had in economic growth was because of the sugar effect of the late 2017 tax cuts that we had, which were having a positive impact on a few quarters during 2018. And as the chairman of the Fed, it behooves you to look further ahead rather than the sugar effect in the short term of a stimulus that is coming from the fiscal side. We did not have anything to make it more permanent. We don't have worker training. We don't have structural changes. So I thought, without doing it and without immigration of skilled individuals being allowed to come into the country, which was not being done, by the way, we were essentially destined to have continued low rate of economic growth. So for all of those reasons, I was pessimistic after the December 19th press conference. And then came January 4th, and he had seen what a massive collapse in equity prices had taken place in the second half of December, particularly on Christmas Eve of 2018. And by early January, the chairman was ready to pivot. This is the problem that they conveyed, that they said, if the stock market collapses, we are here to backstop you. And if I can extend that further, Timur, and this has been a problem with the Fed starting in 2008 with the Bernanke Fed, continuing with Janet Yellen, which is they have taken care of the businesses, they have taken care of the equity market investor, but the wage earner can go to hell. There is no support for him or her. And we had zero interest rate on the bank interest rates. So if you are a retired person looking to your bank interest income to supplement what you are coming to, I'm sorry, we are not here to help. We are here to help some of the largest institutions around. So that was being continued by 2018 and the early 2019 pivot, and continues again with the sharp cuts in interest rates that we have had in recent months.
All right, so that is a perfect segue to your assessment of what the Fed has done in the last couple of months. We thought that we saw unconventional monetary policy 10, 11 years ago. I mean, that all got done, and we have moved way beyond that in the last 4 to 8 weeks. All these new measures that are being taken, including backstopping the credit markets. What's your view?
The basic problem with the Fed, and this is what your question is very apt, it's very timely, suggests the way in which the Fed acts. 2008, it is questionable whether you needed a QE1, QE2, QE3, various forms of quantitative easing or not. But at least the Fed, if it had stuck with Chairman Bernanke's statement toward the end of 2008, that this was a temporary phase to have quantitative easing. Unfortunately, that phase lasted several years. And if it had been temporary, it would have been okay. Then they should have pulled the stimulus. But the Fed is much easier to provide the stimulus, much more reluctant to pull it back. So what they have done, was to increase the stimulus. Then in October 2017, belatedly, they discussed in terms of quantitative tightening, and that went on for 2 years until the mid-September of 2019. They found out we had a repo market crunch, and immediately all the quantitative tightening went out of the window. We were buying bonds back like crazy, increasing the balance sheet of the Fed. Remember, even before coronavirus struck, the Fed's balance sheet had increased substantially from the mid-September level of 2019. And then comes coronavirus. There are two things the Fed did. One has been in steps to cut the interest rate to near zero. Federal funds rate, effective rate is hovering around 0.05%. So basically it's zero. And the second part about it is the increase in all the Fed purchases provide support for all forms of asset classes. So essentially, we are losing the presence of a free market in the United States. It is becoming Big Brother will come to support you depending on who cries the loudest. The fear I have is, once again, if you pick your assets based on a risk-return calculation, you're going to be frustrated. The Fed has started purchasing high-yield bond indexes. And what tomorrow, Timur, if they start buying the S&P 500 index? And so if you think the S&P 500 is overvalued today, it could become even more overvalued if the Fed is going to step in and throw $1 trillion into the market. So you do not have the free competitive market operating. You have the Fed causing a problem with it. Last point. With the zero interest rates once again prevailing as they started to do in early 2009, the consumption spending is going to be negatively impacted in the United States. Most of the people in the United States are not billionaires. They are actually low and middle income earners who do not depend on the stock market. They depend on their wage income. And that is clearly being hit sharply by the coronavirus crisis. And if they thought they would make up some from the bank interest income, good luck. That's not going to happen. So consumption, which is 70% of US GDP, is going to be negatively impacted by these policies. And what we are going to do is to repeat the low pedestrian rate of growth that we had after 2009. We are likely to have that again once the recovery begins after the coronavirus situation currently.
Shri, if I understand your prognosis that we are sort of doomed to stay in a fairly low growth trajectory, even if we go past the pandemic and the stimulus measures, in that case, even this heroic quantitative easing and zero rates, would that manage to stem credit risk going forward?
It can stem credit risk, Timur, depending on what the Fed does. For example, they said that even fallen angels in the high yield market, like Ford Motor Company, if they had been recently downgraded to non-investment grade status, the Fed said it is okay for that kind of a company to be supported by the new program. So let's assume you have an increased credit risk in the energy side, energy-related high yield, as a result of the fall in oil prices. And let's assume the Fed introduces a new program to support energy companies. And if they do that, and they start buying energy-related high yield in a new form of purchase, you don't have credit risk there anymore. The Fed is your friend. So the whole thing is very uncertain, and all of the risk return signals that you're used to seeing are all getting mixed up. And that is the problem that we have currently.
But Sri, there is no free lunch. If we are going to backstop companies that are genuinely under stress and take all solvency risk away by central bank intervention, aren't we then heading into a Japanese-style zombification of lots of companies?
If the Fed is going to insist on doing that, the zombification may very well happen, because then you have no innovation. I don't have to work extra hard in terms of making a profit, because taxes are going to go up anyway to pay for all the people who don't work so hard. So yes, you may be rewarding the ones who are not, and you may be giving the benefit to those who need it, but who are probably not productive, but you're taking it away from those who are indeed productive. So I think that is a big risk. And when you talk about the zombification or Japanization is the other expression I have seen, Timur, is the fact that Japan suffers from an aging population and not having enough of immigration. So the third arrow of Prime Minister Shinzo Abe's three arrows, the third arrow of structural reforms has been fairly ineffective. Same thing in the United States. We don't want immigrants to come. We have had students coming into engineering, coming into sciences from different countries who have been admitted to universities who were refused visas and could not make it. So the issue here is we are turning away skilled young individuals who should have been turned away, which reminds me of former presidential candidate and former New York Mayor Michael Bloomberg's statement that really what you need to do is when you get an engineering degree or you get an advanced science degree, in addition to your degree, we need to give you a green card to allow you to stay in the United States and give you one more incentive not for you to return to your native country. And instead of that, we are doing just the opposite. And that also hurts the ability to improve the rate of growth, improve the productivity of the country.
Absolutely. Sri, I want to stay with the flow of the logic of permissive central bank intervention, backstopping credit risk, leading to Japanification. But what does that mean for the recovery in the near term? We've had a very dramatic rise in unemployment over the last 8 weeks. The hope is that if we start normalizing, then a lot of those unemployed people will get employed again. Is your view that the recovery is going to be much more staggered and we're not going to have anything resembling a V-shaped recovery in the labor market?
I don't believe you will have a V-shaped recovery in the rate of growth, and I don't think you'll have a V-shaped recovery in the employment market either. If you have to put a trajectory, and obviously things change from time to time because it's so fluid, but let me give you my present expectations that after a very, very sharp second quarter drop, so second quarter meaning lasting through June, the third quarter, July through September, I think is also going to be negative, not only for the United States, but for many other countries of the world, especially Western Europe, and a very guarded, slow recovery or at least flat performance of GDP in the fourth quarter, and the employment in turn coming back only sometime in 2021 on a gradual basis. To give you an idea of how I think this malaise on the equity on the production side and employment side are going to be spread, among the major countries, the only three countries I see having any positive economic growth in 2020, meager, maybe 0.5% or 0.3% for the year. Even that, the three countries are going to be China, India, and Indonesia. The developed and developing countries elsewhere seem, at least major countries, seem destined for negative growth. All of this suggests to me that it is going to be very hard to revive production and employment anytime soon. The other part is we have this fear on the employment side of a loss of your skill. So if you were doing something on a regular basis and you've been unemployed for 6 months, it's not clear that you can come back to your old job and take off where you left from. Supply chains are going to be disrupted and skill levels are going to be affected. So that also, I think, is going to slow the pickup in employment during 2021. So what does that mean for stimulus? I think the unemployment benefits continue to be provided. And my measure is that in the US alone, we are talking about a total stimulus between the Treasury and the Fed. To me, there is no difference between the two. The Federal Reserve acts as if it's part of the Treasury. Put together, they provided stimulus of about 50% of the US GDP of $21 trillion at the end of 2019. It's massive. So if that continues into 2021, and you don't pull back when the recovery starts, even on a slow basis, we have adverse consequences then with a pickup in inflation in 2021, 2022. US Treasury yields start to surge and the dollar plummets. You have a whole lot of adverse consequences which could happen in 2021 or more likely 2022.
Okay, lots of dramatic scenarios were painted in the last 30 seconds, so we need to unpack that a little more. Why would inflation come back?
Inflation comes back, in my opinion, Timur, if in 2021, the immense stimulus that has been provided this year is not reduced as the economy comes up. Look at the past. We provided a lot of stimulus in the 2008 crisis. They were not really pulled back after that. 2017 made a half-hearted attempt at quantitative tightening and then gave up. The fiscal side of it, there was no pulling back. If anything, we added one more tax cut in 2017. So it is not going to be possible to go to 2021 and say the Fed is going to increase interest rates. The Fed is not going to keep purchasing bonds. It is actually going to put bonds back into the market, do quantitative tightening. It's just not going to happen.
Okay. Do you think the Fed is capable of weakening the dollar?
I think the Fed is capable of weakening the dollar. Again, in terms of how that can be done, you can always increase the amount on quantitative easing side. And I had said as soon as the coronavirus crisis began that the US dollar would strengthen. And the reason is that the US dollar is still the safe haven. The United States is still a safe haven. US treasuries are a safe haven. And therefore, if you are afraid of what would happen on a global risk basis, you put more of your cash in US dollars. Now, fast forward to 2021 and look for an economic recovery taking place. You do not need a safe haven as much as you needed it in mid-2020. So in mid-2021, you are going in for risk-on assets and you do not need the dollar anymore. And if at that stage, the Fed either does not do quantitative tightening, and I don't expect it to do that, or if it actually goes ahead and provides more quantitative easing, more of cash flowing into the system, you are providing more cash into the global economy when the global economy is moving away from the US dollar. That is how the US dollar weakens. And my professor for my PhD thesis, Robert Mundell, essentially talked about money demand, money supply in the two different countries, country A and country B, as the determinant, the prime determinant of the exchange rate between the two countries. And that, I think, to me, leads me to believe that you're looking for a weaker US dollar by 2021 or 2022.
A weaker US dollar and a pickup in inflation at a time of soft recovery, would that then be accompanied by strengthening of energy prices like oil?
Again, you're looking now, they essentially looking at the mirror for making the forecast that far ahead becomes a bit cloudy. But then in terms of where energy prices are headed, if you just said the economic structure of the world doesn't change, yes, you are talking about the oil prices rising as the global economy picks up, and particularly the three biggest oil importers in the world, Japan, China, and India, also have economic growth which are much better in 2021, 2022, and oil demand increases, you can look for oil prices to increase. The other unknown on the oil side are structural changes. You are seeing even energy inefficient users like China and India deciding to use energy conservation measures. There is more worry about pollution and use of alternative means of transportation. It is principally focused in the United States, but it is spreading in the other parts of the world as well. When you take those into consideration, I would say short term, meaning give myself 2 years, oil prices rise, but give myself 10 years, oil prices are probably under pressure again for structural reasons.
I think I fully agree with that. A few weeks ago, we spoke with a Middle East expert who's very close to the Saudi royal family. And he was making the argument that as far as Mohammed bin Salman is concerned, even if Saudi Arabia has 50 years worth of oil reserves, they would probably want to pump it all out in 20, because the view is after that, the oil just would have to stay under the ground between global regulation and public opinion that fossil fuel would be, or has no more than 20 years. So from that perspective, the long-term energy outlook, in my view, I fully agree with you, is rather bearish. Sri, in the last 3 months, the number of investment newsletters that have gotten proposing that one should be long gold is alarming. I think of gold as not a very serious asset because it doesn't pay any dividend, it doesn't have any intrinsic value, but smart money in the hedge fund world, among the high net worth individuals, seems to be more and more sort of attuned towards owning gold as a part of a diversified portfolio. Do you take this thing seriously or not?
I take the gold argument seriously. I do think as well that gold prices are due to go up further from current levels. I would answer your question in several parts, Timur. In the short term, look at the recent movements. The one time you will see that the gold price really plummeted what took place in March of this year, along with US Treasury yields spiking, going well over 1.5%. After the low the US Treasury hit in early March, it spiked up later on. Gold prices fell and equity prices fell in March until the March 23rd low. And why is it that gold price fell at that time? That was the time when investors were essentially leaving all physical assets, financial assets, and simply going to cash, which meant that you're pushing down equity prices, raising bond yields, and also pushing down gold prices because you're giving up gold and holding on to cash. With the exception of that, gold prices have continued their march upward. Look forward a year to year and a half. I think what's going to happen is you're going to have zero interest rates in the world, maybe even negative interest rates in the United States and Europe. And that means the cost of your holding gold is very little. The cost is high if you're giving up on earning 5% or 7% return on your bank account, and instead you're holding on to gold with a zero return. That's not the case. Instead of 0 or minus 0.5%, it is much easier to justify holding of gold. Second, if you're looking at a situation where the dollar gets debased in 2021 and 2022, think about a rise in the price of gold as a debasement of the dollar. Bob Mundell used to say that the gold is the ultimate currency, and that in that situation, you essentially are looking upon the gold appreciating as a currency relative to the dollar, which is another way of saying the gold price goes up, measured in US dollar terms. And I think both the factors are going to become effective in terms of pushing the gold price further over the next couple of years.
Well, I can see that the market is already sort of in line with your views in terms of what's happening with rates vis-a-vis the gold in the last, say, 4 to 6 weeks. And I think the trend is unlikely to be turning around anytime soon. Shri, we have talked about, particularly with respect to the US, the unconventional measures that the central banks have done, and you cited a very large number in terms of total monetary fiscal measure for the US. Now, the US, of course, can behave irresponsibly if it chooses to, because it has the advantage of having the US dollar for the time being the world's reserve currency. Emerging market countries, from Argentina to Indonesia to India to Brazil, South Africa, do not have that luxury. And they have been hit with the financial contagion even before the pandemic hit them. And now, of course, a bunch of the countries that I just mentioned are still deep in the middle of the pandemic. Robert Schiller at Yale talks about this dual pandemic, that you have a financial market contagion and the COVID-19 contagion. Your view on EM in general?
I think emerging markets have a further downside to go. Again, we spoke about 3 countries alone are likely to have any kind of a positive growth this year, and all of them happen to be in emerging markets. So you might say that some of the emerging markets perform better than the developed countries, but still the risk is, as you said very correctly, Timur, they do not issue a currency that isn't internationally acceptable to the same extent the dollar or the euro would be. And therefore, they are at a disadvantage. The emerging market debt is denominated in dollars. And again, you mentioned Argentina, a country that I have followed since 1979, 1980. And I was surprised at the amount of money that went into the 2017 Argentine bond issue. Here is a country which has defaulted several times, and it defaulted again. I'm not saying the other countries are going to default also in the same style as Argentina, but emerging markets are typically more dependent on exports and the rest of the world than they are on the domestic demand. So it is not surprising, it is not coincidence that the 3 countries I mentioned with positive growth in 2020, China, India, and Indonesia, are also ones with a very large sized domestic population to help out. But in the case of very many other countries, you don't have that backstop. And to the extent they are depending on the global economy, and Europe, we are talking about depending on the country, -6 to -10, -12% GDP change this year. And you're not going to have the economic growth come from the export side. Second, oil prices on the whole, higher oil prices are good for emerging markets rather than negative. You again have exception. India, again, and you had a great interview with Raghuram Rajan recently, Timur. And you know that India is a country which benefits enormously from lower oil prices rather than higher oil prices. But typically, emerging markets want higher oil prices to take place. That's not going to happen. So the slowdown in economic growth, exports to developed countries, the weakness in international oil prices are both going to be negative for emerging markets. Third, and the very important item, is the dependence on foreign investment flows. And I like to think about emerging markets and to make investments in emerging market countries that are more dependent on foreign direct investments than they are dependent on short-term capital flows. Examples, on the short-term speculative capital flow side, we have had the dependence in South Africa. We have had the dependence enormously, famously in Turkey, which did not fare out very well. On the other hand, India, China, Brazil, and to some extent Mexico are very dependent on foreign direct investments. And this money is sticky money. It stays for a long period of time. And Argentina simply does not have that benefit. So you look for countries which are going to benefit based on FDI coming in, and be careful with countries where the FDI doesn't go to. Another point to look at is in terms of how these countries have performed in terms of the deficit on the current account of the balance of payments. And over the years, I have used 3% of GDP as my mental maximum for the calculation. So if you have countries with a lower than 3% current account deficit, think about that as being easily financeable. And if it is 5 or 6%, as was the case with Turkey before the crisis, even a couple of years ago, that is a danger signal for you to look at. Last point is, once you have determined what the current account deficit is going to be, what percentage of that is financed by FDI flows rather than speculative capital inflows? So in other words, your current account deficit is given, and I'm asking you, how are you financing it? And in the case of Brazil, while it has had small current account deficits, the FDI flows coming in have been substantially more than that and more than enough to finance the deficit, which makes you feel confident that they are not going to have a foreign exchange crisis. Countries which don't have that cushion, you need to be extra careful about.
Well, that's sobering, but I think that is as realistic a portrait one can provide for the emerging markets in such a short period of time. Sri, we began with developed markets. You brought us into the emerging markets. As a final question, what's your sense of the buy-side investor universe? Are people and institutions basically looking at very defensive investment strategy, or as you characterize emerging markets problems, but with some differentiation that there is an inclination to look at countries that are less vulnerable than the other, or are emerging markets being lumped as unsafe, and the U.S. Treasury and a few other assets are basically only things that people are seriously looking at?
I think there is clearly, at least on the part of skilled institutional investors looking at the buy side, and now we are talking only about emerging markets. I think there is clearly and not only an incentive, but also a move to distinguish countries one from the other based on these characteristics. I don't think emerging markets are being lumped together. That was probably a phenomenon 20 to 25 years ago, where it was yes emerging markets or no emerging markets, and then you decide one way or the other. Now we are talking about a world in which emerging market collectively GDP-wise account for 60% or so of the world product. So you cannot ignore emerging markets anymore. I think where the skilled investor comes in is in terms of deciding which countries to go into and which not to. And again, buy-side managers use different criteria. I mentioned the 3 criteria that I mentioned to you: current account deficit, FDI, and FDI as a proportion of current account deficit. But other buyers may effectively use other criteria to do that. But I think you need to do that to go into the emerging markets. I think you need to be very much in emerging markets if you're looking for returns over the long term, whether you are emerging market only manager or you include it as part of your global portfolio. But it behooves you to be very, very careful how you include them rather than go for the jugular in this. And as I said, the 2017 Argentine bond issue, for instance, did attract a lot of quote unquote sophisticated investors, institutional investors, and very many of them are taking their lumps. And when it was not clear to me why they did it, because I had always thought about the country as prone from one crisis to another crisis, but it did attract investments. So you can make mistakes, But people do use their judgment in terms of deciding whether a country has turned a new leaf. So you look at economic policy, you look at the economic characteristics in terms of deciding what you want to do.
Sri, I had the pleasure of being the IMF fiscal economist on Argentina in 2006. And so many things have changed around the world. But when I read about Argentina, I feel like the country hasn't really moved that much from 2006, or maybe even earlier than that.
Yeah, you have a great experience to speak about Argentina, Timur. I would love to exchange thoughts with you the next time we are able to meet in person.
Oh, with pleasure, anytime, Sri. What a comprehensive and to the point discussion from you. We are very grateful for your time, Sri. Thank you so much.
You're very welcome. Thank you very much, and all the best to you.
Thank you. Thanks to our listeners. You've been listening to Kopi Time. You can find all our research and multimedia by Googling DBS Research Library.